So we've talked about why retail sales will slow, but we need to look at, well, what were retail sales in June? So retail sales were softer with an increase of 0.2% versus the estimate of 0.5. Sales ex autos came in at 0.2 versus the estimate of 0.3. Control group, which was actually quite good, came in at 0.6 versus the estimate of 0.3. And we want to talk about why that was the case, because a lot of that was from online buying, which we want to evaluate. And then goods consumption remains above trend relative to services consumption, which is an interesting backdrop, because when you look at real personal consumption pre-pandemic trend, you're seeing that fairly consistent. And then real personal goods consumption relative to services, but it's falling. And that's when you look at, the U.S. consumption rotation, it stalled a bit because you did get some prices coming down on the goods front that incentivized some buying as those prices exploded. People are like, all right, well, we need to pull back a bit on this. So you're getting some of this balancing act that is playing out, but it's important to look at things on a U.S. retail sales nominal versus real and looking through history. So after adjusting for inflation, U.S. retail sales fell 2.5% over the last year, the eighth consecutive decline. That's the longest down streak since 2009. Nominal retail sales increased 0.5 versus a historical average of 4.7%. So again, it's the pace is slowing, but it's still positive. And obviously, when you look at a year-on-year basis, the comps are pretty hard. So it's not like you're getting this huge drop off. It's just something that the pace is slowing. And as we've been saying, and as we showed in the previous segment about Redbook and those sales, you've seen that drop off. Even as they were dropping off, they were still positive. It's just they now finally turned negative in July, end of June into July, which is why we think that we've now kind of turned that corner, and you're going to see more of that pain to the downside. Now, here's an interesting piece where, hotel occupancy rates by week of the year is down 2.3% year on year. Now, it's interesting because when you look at it, we should be seeing an increase. And our commentary has been it's going to go sideways. And so the comps get harder, which means that instead of hotel occupancy being down only 2.3%, it's going to be down further. Now, we talked about this on the EIA show, but I want to reiterate it because we were in Boston meeting a friend of ours who is a very high up in one of the big hotel brands. And we were talking about numbers, and she was saying that the average for their hotel chain, the average is down 12 to 15% year on year. Her facility in Boston, and where she's in Boston, it's only down 8%, but it's still down. So you're talking about sizable single digits, multiple digits. Now, this is interesting because it's looking at the average going back to 2000, and it's looking at it year on year. Her brand has again levels that go from the very low to the very high. So this is also showing that people are also pricing down, and you're starting to see some of those shifts. So it's not that she's wrong. It's just this is looking at everything, but net you're seeing less spending during a period you should be seeing more. As you can see, things pivot up because we're coming into that peak travel and vacation period, which, as we've said, is slowing down. Then when you take that to the next level, the port traffic, both inbound and outbound, continues to plummet at the port. On a rolling 12-month basis, inbound traffic decreased 1.8% in June compared to the rolling 12-month ending in May. Outbound traffic decreased 0.3%. And that's where you're seeing that officially again come off as we see that pressure point, which we've continued to highlight in the EIA show, and just less imports, less demand. So now when we look at year over year percent change in retail sales, consumer spending momentum is still positive but softening. Retail sales momentum has slowed from 7.4% year on year at the start of the year to 1.5%. Core retail sales still holding at that about 3.8. Sales are down 1.5% year on year in inflation adjusted terms, which is the pivot piece. So Core is starting to flatline, but total retail is rolling back over. And one of the things that we were saying is that March was kind of that last hurrah of that little bit of love. And now you're getting that sizable drop off, which is just accelerated through and what we've seen so far through July. Now, the massive inflation surge, incredible consumer resilience when you look at dollars spent, but when you look at more caution in terms of volumes from inflation erosion, higher rates, and less labor market support. So when you look at some of the drop off on the real retail sales, the trend is slightly down, but when you look at nominal, that's where you got this big pivot shift when you're looking at real retail sales versus nominal. And then when you look at, again, as we talked about in the previous segment, we talked significantly about the issues about credit card rates, credit card delinquencies, rejection rates, and this is why we're going to see some of these pain points increase. Non-store retailers saw a big spike of 1.9%, which is what drove the control group up. So this non-store retailers is what drove this. So if you take that out, we were actually below estimates. And I'm not going to be that guy that said, well, if you take out the highest thing, therefore it'll go lower. It's just the non-store retailer side can be a bit lumpy, as you can see in terms of how it kind of bounces around. So that's why we're more confident saying that this is more of a one-off and not a meaningful pivot change. And we're going to watch this, because if it's big again in July, we're going to have to rethink that. It's like, oh, well, maybe this is a pivot change. We're not really seeing that yet, just based on the other data points we talked about in the previous segment and so far in this segment. Then when we look at industrial production, again, showing kind of that negative move, you get an idea how the total index for industrial production is now negative. Advanced retail sales are hovering at flat. But when you look at the advanced sales, which a lot of that can come from that non-store piece, you're seeing that pressure coming back to the downside, which is why we have a bit of that confidence that you're going to get that rollover. And then the real retail sales growth have remained in persistent contraction over the last 70 years. Sustained contractions in real retail sales overlapped with recessionary periods. One false signal occurred in 1967. So again, we're just looking at data sets. We're looking at data points. Obviously, you had this massive surge, this big decline, but it's just when you see this declining ratio, typically it is signaling a much bigger problem. Now, U.S. import prices have started to fall. Estimate was for negative 0.1, came in at negative 0.2. And it's just because there's less going out. This is in terms of what we're importing. We're able to import a little bit more deflation. But the problem that we see is as we get more onshoring, more nearshoring, that's going to balance out a bit, and we're not going to have the same benefit as we go forward. Not to say it's going to be an increase, but you're going to see that dwindle a bit in terms of some of that benefit on the CPI side. Now, when you look at the convergence on the lowest earning worker, the blue line, and the highest earning wage growth, former softened to 6.5%, while the latter moved higher. But it's interesting because even as the high earners goes up, you're actually seeing them having a harder and harder time managing their bills. And then the lowest earning quartile, which always has an issue managing their bills, is seeing their wage growth come down. Again, none of this is positive for a continuous increase in underlying sales. Higher interest rates continue to put a damper on home purchase conditions. Not surprising, I'd be shocked if it wasn't. And then when you look at the surge in mortgage rates, that has been the biggest issue, which initially coincided with a huge drop in home builder sentiment. But now with the stabilization in rates, you start to see a little bit of this backdrop where people are getting a bit more comfortable with it. But the national home builder side, the national home builders, you have to look at, well, are they talking single family, multifamily? Because there is definitely a tale of two cities when you're looking at the build out of underlying assets. July Empire Manufacturing Index came in at 1.1 versus the estimate of negative 3.5. It was 6.6 in the prior month. New orders ticked slightly higher. Delivery times fell further. Employment popped back into expansion, and the outlook softened but remains in expansion. So again, it's kind of that mix where Philly's showing something a bit worse, Empire showing something a bit better. But what we were talking about in the previous segment, Philly is a little bit better gauge, which is why we see some of those downside. Now, there's still other regional data to come out, so it's not like we're going to jump to conclusions. But again, the Philly one is showing that additional reduction. Prices paid still in expansion, but again, as you can see, it's still moving down in the right direction. Prices received, something similar, still not in deflation, but again, still moving in terms of that change in the rate of change that we've talked about. One more spot, one sore spot for the Empire Manufacturing was the lower in outlook for CapEx. And that's why when you look forward a bit, within that different piece, that's where we see some of those leading indicators of the 6-month side, as we talked about with the Philly Fed, looking at those new orders coming down, remaining into steeper contraction. We still see a lot of that pressure point. But then when you look at the good news, it's obviously that the prices paid continued to weaken. Now, industrial production and manufacturing. Industrial production came in at that negative 5% in June, with May revised lower. Durables came in at negative 0.1 with weak autos, machinery. And then non-durables came in at negative 6% on a broad-based decline. So that's not great when you're looking at the industrial side, some of that piece, but then the less diffuse weakness in manufacturing, the share of manufacturing sectors in contraction fell back below 50% for the first time since Jan, after peaking at 66%. So it's not a full broad stroke. It's just there's a little bit of this balancing act that we have to look at in general. So then when we look at rents, again, things that impact people, data from Redfin shows the median asking rent in the U.S. is still only $24 below its record high, $2,029 in June, up from 2019, a year earlier, slightly below the record of 2053. But again, you had some of that deflation. Now you're starting to get back up. And again, this is why we talked about it last week, the increase of that owner's equivalent rent. You still have some of that deflation or disinflation coming through, but again, not a huge adjustment, and that's where we actually start to see it come back up, which is an underlying problem. Housing market index from the rose to 56 versus the estimate of 56. Present sales moved higher, but future sales ticked lower. Prospective buyers traffic moved a bit higher, but again, as you can see, it kind of bounced off the bottom, but we see it just flatlining a bit as we go through some of the other data points. July update for University of Michigan consumer sentiment showed uptick in 1-year inflation to 3.4%, and then 5 to 10-year 3.1%. So people are still seeing a bit more of that inflationary pressure. Consumer sentiment index surged to 72.6 versus the estimate of 65.5. Expectations climbed to 69.4 versus 62. So typically when you get an adjustment in mortgages and the stock market had a nice little rally, people will feel a bit better. Our thing is that we see this, again, slowing down just a bit. Then you look at latest update from the University of Michigan Consumer Sentiment Survey showing buying conditions for household durable goods are back to June 2021 levels for vehicles, homes, taking longer to catch up. And when you look at homes, that is the orange line or yellow line, which you can see is still at levels not seen since the 1980s. But the number of multifamily units under construction climbed to 994,000 in June, which is tied for all-time high reached back in May 1973. And the issue is when you look at rates and you look at where people are looking at rates and saying, well, I'm not going to sell my house now to buy something more expensive. So they're going to rely or wait for, because people aren't going to sell, therefore there's not going to be as much volume. So they're going to have to wait for new builds or new construction to come on in order to make that jump and to make that move. Multifamily building permits have come down, but that doesn't change the fact that new privately owned housing units under construction, building with 5 units or more, has taken out that high from the 1973 period. And that's what we've talked about with more of that volume, more of that will come on and help alleviate some of the issues. New privately owned housing units under construction have fallen, but building permits are starting to come back up. Still in contraction, but again, starting to see some of that balancing act as people are looking, if they look to move, because there isn't a whole lot of volume out there given people, sitting in their homes, which is why June existing home sales came in at negative 3.3% month on month versus the estimate of negative 2.1. The surge earlier this year looks to have been temporary. Number of homes for sale at 1.08 million, which is the lowest since June. Inventory medium selling price down slightly from a year ago to 410,000. And then the spread between number of housing units completed versus under construction ticked lower in June and stayed in negative territory, still off lows, because again, we still have a huge backlog of inventory to come on, and existing home sales, there's a mixture of people just not wanting to sell, because if I sell my home, well, I have to go get a new home, and I'm going to have to get a mortgage rate of 6.5%, 7%, which again is just massive when you consider where it was previously. And then rounding this out, June housing starts came in at negative 8% versus the estimate of negative 9.3. Building permits came in at negative 3.7% versus the estimate of positive 0.2. So housing market indexes for prospective buyers, even through 6-month change, was the same in July as in June, and it's still staying fairly stable. So again, it's kind of a mixed bag. The problem is mortgage, MBA index is down, meaning that less people are looking for mortgages. As we talked about in the previous segment, in the beginning of this segment, mortgage rates are being rejected. Mortgage loans and mortgages are being rejected, which is why, and we have someone in my wife's family is a realtor, and she's had several homes fall through because they had issues on the financing side and they were unable to get a mortgage, which is becoming a much bigger issue. So again, that's something that's going to weigh on some of these things going forward. That's what we have for you on the U.S. side. In the next segment, we're going to go deeper into Europe and some of the issues that continue to permeate throughout the continent.